Last year, when most investors were watching their stocks plummet, one Wall Street legend had an unfair advantage that was identifying winning stocks with massive upside. Like Riot Blockchain before it shot up 10,090%, Digital Turbine before it shot up 789%, Overstock.com before it shot up 1,050%. This power gauge comes from the legendary Mark Chaikin. Right now, you can get a free in-depth look at how his power gauge system works. A way to type in any of 4,000 different tickers and see exactly where the stock is most likely to go next and in any type of market. Simply go to powergaugepreview.com for a free look. Again, that's powergaugepreview.com. Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's December 13th, 2022. And we got a really special show coming up for you. We had the inflation number come in this morning, lower than expected. Stocks are rallying, Bitcoin's rallying, gold's rallying. We're going to break down every number that makes up the CPI and more. Coming up right now on Making Money. Again, this is Matt McCall. Thanks for joining me. It is the 13th December 2022. The year is getting closer and closer to the end. But we did have one more CPI number before we close out 2022. The number for November just came out this morning. And I got to tell you, it was much better than expected. We're seeing the stock market rally, Bitcoin rally, gold's rallying, the dollar's getting crushed, yields on interest rates or on treasuries coming down. We got a lot to talk about. I mean, I got pages and pages and charts to show you what happened. But let's get to the headline number here first. We're looking for a year-over-year CPI increase of 7.3%. And that's the consumer price index. This is the inflation number, folks. Looking for 7.3% year over year. It came in at 7.1. Last month, it was 7.7. So we're seeing it dramatically come down. This is the lowest level we've seen in over a year for the CPI year over year number. Then we look at the month to month. The expectation was from October to November, the CPI would increase by 0.3%. It only came in at 0.1%. Last month, it was 0.4. Again, dramatically rolling over. As I've been saying, we peaked. This was going to happen. Take a look at the core CPI. This is ex food and energy. Core CPI came in at 6%, lower than the 6.1 expected, and again, lower than 6.3 last month. We look at the month to month, up 0.2% versus 0.3 expectation, lower than last month at 0.3%. So what we're seeing right now is really the rolling over of inflation, getting to a point now where we're seeing what the Fed has been doing. We're seeing that prices that we've started to come down a little bit, really making its way into the market. And we're about 4 minutes into the trading session here, 9:34 East Coast time. I want to do this when the market open. We have the S&P up about 100 points, about 2.4%. The Dow Jones Industrial Average is up about 550, 600 points right now. But this morning, pre-market, when the number first came out, the Dow at one point spiked up nearly 1,000 points. We got a long day ahead of us. We'll see how we react to it. But I will say, top line looking at what's going on, I'm about to break down these numbers like you wouldn't believe. But top line looking at these numbers, what it means for you as an investor is that inflation is cooling. Inflation is coming down. Inflation has peaked. So if you believe that inflation was really the catalyst to a lot of the selling, the bear market, the slowdown in the economy, that is behind us. We don't get to 2% overnight. I'm going to show you a chart to show you how we get to 2%. We don't get there overnight, but we are moving in the right direction. By the time the CPI gets to 2%, the market's already going to be moving. Now is the opportunity. Now is the time. Today was that signal to let you know it's okay to start buying stocks again. I don't know if today was the bottom, with the stocks. I don't know if the bottom was last month. I don't know that. We could retest it. I have colleagues here to believe we go way below that. There's a lot of people on Wall Street believe we go way below those lows. I don't think we do. I think the odds are probably 20% that you break it, 80% we stay above it. Could we have a volatile run between now and middle of next year? 100%. But I think the bottom's in, especially for specific stocks. I think we've seen a lot of bottoms in individual companies that you could be buying right now for 2, 5, 10 years, looking out longer term. All right, so we got a lot of charts we're going to break down here. The first one I'm going to take a look at is kind of just looking at the overall of different categories here. So let's take a look at this. These are some select categories in the CPI. As I mentioned, overall, we're up 7.1%. So you can see down here where it shows that orange, it shows all items. So some of the items were still much hotter than the overall inflation. Fuel oil still up huge. Airline fares, which I'm going to break down, still up big, but there's something positive in there. Dairy, electricity, motor vehicle maintenance, gasoline, etc. But then we look at some that are below that. Meats, poultry, fish, and eggs. Alcoholic beverages, believe it or not, coming back. Apparel, hospital services. Used cars and trucks are now negative. That was a hot spot last year, I guess this year, early, middle of this year. They were going through the roof, especially last year after the pandemic. You couldn't get your hands on used cars. I mean, you were paying prices for used cars that were more than what they paid for them when they were brand new. So I want to break down some of these other ones in there, these numbers, to kind of show you what's going on. And I'm going to show you airline fares. I just talked about that. So let's take a look at airline fares. Still high, folks. Airline fares are still up 30%, 36% year on year. However, in October, it was up 42.9% year over year, and month over month, down 0.3%. It's tough to see, but in that upper right corner of airline fares, we've peaked and we're starting to roll over. That negative 0.3% is actually a really big month over month decline. It may not sound like that because the year over year numbers are so big, but it is a big decline. And I think we come back down to the mean here. We come back down to single, low double digits at some point in the next couple of months. And again, this will then be reflected in a lower CPI number. A couple other we want to break down some, within there, some numbers. And here's a big one here. These are gasoline prices. Let's take a look at this. This is the daily national average gasoline price, the lowest since October 2021. If you remember back in June, the average gasoline per gallon was above $5 for a few days. We're now down to $3.26 per gallon. Again, the lowest level since October of 2021, over a year low when it comes to gasoline prices. What I'm really trying to show you here is just how everything's starting to roll over. We're not where we need to get yet, but we are rolling over, which is really important. There are two areas that I want to show you really quick that still do remain quite high. One of them we'll take a look at here. This is the Urban Consumers Food. You can see the food numbers here. Well, if you take a look at the food numbers, this chart, as you can see, still going from lower left up to the upper right. And you take a look at the change here in the food component. It's still relatively really hot. I mean, this is still hot. However, I'm talking the blue line there. Look at this line right here. The line below that, that's the annualized change. It peaked out at 13.9%. We're now down to year over year, 7.8%. So again, even though the blue line looks hot, it's the overall number, it's coming down year over year. And that is really important. We're starting to see things, again, folks, roll over. And it's all about the trend. It's not about necessarily what we're seeing right here today. It is more about the trend and what's going on. Another one that still looks hot, and this is the one I've been talking about more than anything. This, to me, is the canary in the coal mine. And this is shelter. Shelter makes up over 1/3 of the CPI. This is a part of the shelter. It's called owner's equivalent rent. And if you look at the trend here, they call it OER. The 3-month annualized change is still hot, about 8.8%. But it looks as if we may be peaking there. And when this starts to roll over, the CPI absolutely will tank. Tank. You look at numbers outside of the CPI. I talked about this last week. I believe it was 92 out of 100 of the largest metropolitan areas in the United States are seeing rent come down. It's over 90%. We're seeing home prices overall start to roll over. These are lagging indicators for these CPI numbers. Once this goes into the CPI numbers, and they are rolling over, it's a combination of prices that went up too high, too fast, too much, too fast, as the Grateful Dead said. A combination of higher mortgage rates because interest rates are going up more. It costs you more to borrow. You can buy less house. And a lot of people are just feeling shell shocked and they're not looking to buy homes right now. And they believe prices will come down, which they likely will. So you're seeing home prices roll over, and that's going to continue for the foreseeable future, in my opinion. At the same time, rents are absolutely coming down. So just a couple others I want to look at here. As I mentioned, fuel oil was up big, 65.7% year over year. We had transportation still up at 14.2%. Shelter came in at 7.1%, in line with the overall CPI. That number, I believe, gets down to 3 to 4% early next year, which means most likely the CPI is down at the same darn level down there next year. I'm going to show you how we're going to get there as well. I talked about used cars and trucks. They fell sequentially 2.9% in November. It was down 1.1% and down 2.4% in September and October, respectively. This index has now declined month over month for 5 straight months. And it's now actually down 3.3% from the 2021 levels. This was a big component that was pushing everything higher. So it's nice to see this really start rolling over. And just some other numbers that are actually pretty low. Physician services only were flat, actually, 0%. Dental services up 1.1%. Eyeglasses and eye care. I'm going to the eye doctor on Wednesday, down 2.5%. Hospital services down 0.3%. Nursing home and adult daycare only up 0.4%. Health insurance down 4.3%. These are things that an aging U.S. population are paying for. So these are good seeing these come down. Men's and boys' apparel only up 0.3%. Women's apparel flat. Footwear only up 0.1%. That's good for me. I love my shoes. Jewelry and watches up 0.9%. None of these specifically are important, but together we're starting to see things that people spend money on, things that matter to you and I. Prices, they're not all negative yet, but they're much less hot than they were a few months ago. And again, this is all eventually going to roll over and start seeing prices come down. And again, it's what we're seeing here, folks, is really tough to ignore what we're seeing. All right, a couple other charts here I want to show you. This is probably the most important chart. And this is going to be the chart that is going to be looking at exactly how we get to 2%, if you want to call it, 3% inflation. And if we take a look here, this chart's pretty amazing. This shows the top. It's a bit messy, but it takes us from June 2021 and works its way down to October 2022. It doesn't have November's in there yet. But November's was obviously 7.1. So you can see we peaked in June and we've been going lower ever since then. And it now looks at if we have a negative 0.1% month over month, a flat positive 0.1, etc. So if we were to say we're going to go from November at 7.1% and we somehow get a 0.1% like we had this month. If you look at that, if we continue, by April, we're down to 3.7% CPI. By May, 2.76. By June, 1.38. Even if we have 0.2%, by June, we're at 2.19%, which we'll be jumping in the streets happy about that. And the reason these prices, even though it increases month over month, the reason that we come down, because the year over year comparisons start getting very difficult, much higher prices as we get later into the year. I have an interview I'm going to play on Thursday with Scott Garlis. He's the editor of the Stansberry Newswire. Analyst has been around as long as I do, one of the best guys with numbers. We had a discussion that you can watch on Thursday. And we talked about, because of the year over year, there is a possibility that by mid-year next year, a pretty high possibility, we see CPI down at 2% is where the Fed wants it. And we could potentially see a negative CPI late next year because of the extremely high comparisons year over year. And it sounds crazy to say. I was sitting at my desk yesterday talking to some people, and I'm thinking, and I said, hold on a second. I said, you realize it's middle of December right now. We're concerned about CPI being near the highest level we've seen in 40 years. We're concerned about the Fed raising interest rates. We're concerned about all these things hurting the economy and hurting the stock market. But do you realize that in 1 year from now, I mean, I remember last December, it goes pretty damn fast. I remember it like yesterday. In 1 year from now, we could be discussing the Fed cutting interest rates, most likely, and a CPI well below 2 and possibly negative. If I tell you that and you say you still don't want to own stocks here, then I don't know what to tell you. Again, I don't know if we've bottomed. We could still see a little bit more downside in stocks. I wouldn't be surprised. I think the odds are low that we break below the October lows. But if you're looking at 2, 5, 10 years, and most people have a 5 to 10 year horizon minimum, you want to start looking at buying stocks here. Because by the time the CPI gets down to 2%, by the time the Fed stops, pauses, and then pivots, it's going to be not too late, but you're going to miss an opportunity of the decade, really. You're going to miss an opportunity of this decade of stocks, individual stocks that are demolished. I'm not going to name names here, but you know a lot of the names, even large cap names that have been crushed. You will have an opportunity, folks. So please do not forget that. A couple other charts I'm going to show you here real quick, just to kind of show you where we're sitting. This is the put-call ratio, folks. We're sitting, goes back to 1990. You can see on the right-hand side of this chart up top. For every call, that means that's a bullish. That means you're buying and you think stocks go up in the future. And a put, if you're buying a put, you think the stock or the market you're buying that on goes down in the future. It's at 2.15. Means for every call, there's 2.15 puts being bought. It's the highest level we've seen in decades. That means people are extremely negative coming into today. It means people think the market's going to get crushed. But if we take a look back at other times it spiked about 1.5. One time was right here, beginning of 2009, the highest level we've had other than right now in the last 3 decades. That was about a month away from the bottom of the 2008-09 great financial crisis, and a time that was one of the probably the greatest buying opportunity really since that time. Since that time. We also had a spike back in COVID. We had a bit of fears here late 2018, early 2019, 1.5. But we're at levels now, again, that we don't see very often. It's very rare for us to see that. And it's tough to ignore it, folks. It really, really is. Here's another one with the put-call ratio as well, showing something very similar. However, this shows the all-time record premiums paid for puts versus call. So this is again, we're at levels that's a record level. So people that were buying puts here, they're paying all-time record premiums. They're paying high prices for this protection, for the insurance, for the negative call, the bearish outlook. They're paying even more for it. Not only is it high, they're paying more for it. And just one more here to kind of it ties us all together. And this one I'm going to show you. This is pretty amazing. It is the Bank of America Global Fund Manager Survey. And this shows that the investors are underweight stocks relative to bonds at a level we have not seen since March 2009. Much lower than COVID, May 2020, but 2009. Again, it just shows how negative people are. And we know what happened in March 2009. The best buying opportunity we've had over the last really 19 years or so, 20 years. So again, folks, I know I'm filling you with charts, and Thursday we have even more charts. Wait till you see what Scott shows us. We came at this market and the situation, we tried to compare it to markets over the last 50 years from different angles. Every angle tells us one thing, and the numbers are almost all the same. So you have to watch Thursday's show to find that out, but that's really, really important. So the Fed funds futures, which try to figure out what the Fed's going to do next, they came out and they changed after this. Now there's about a 97% chance we're going to have a 50 basis point 50 basis point increase in December. we're leaning towards it anyway, but now they're basically saying 75 is off the table after this number. And I agree with that. I've said the last month we're going to have 50 in December. Then our next meeting is February 1st. There's now a higher percentage that we could have a potential only 25 basis point. The next meeting after that is March, and the odds are for 25 basis point there. You add that together, 50, 25, 25, it means there's another 100 basis points on the upside until the Fed pauses. So that's 1% on the upside from here. It could end up being 1.25. We could have 50, 50, 25. It all depends what the number comes in early January for the December number. But if it continues in this direction, as I'm seeing, I think we could see 25. I think it's almost certain that the Fed pauses after the mid-March meeting. And again, I think we pivot and we start lowering rates by the third or fourth quarter of next year because inflation is going to come down and maybe the economy doesn't really pick up. Maybe the economy slows down as well. And that will give even more fuel to the Fed to start lowering interest rates. I'm not saying it's the right thing to do, but the way things are setting up, I see that as an absolute potentially possibility that we could see something like that happening here in the near future. Just give you an idea of what happened when this number came out. Europe's tech index surged to the highest level since April of this year. It was up 3.4% at one point this morning. We had the U.S. dollar index down 1.3%. We also have Bitcoin spiked above 18,000 at one point. First time we've seen that in quite some time. Right now, we have Bitcoin trading 17,916. So just below 18,000. We're up about 5.4% in the last 24 hours, up about 2.7 in the last hour. The last 7 days, we're up about 5.3% as well. So it's basically been flat for the last week or so. But you're seeing a little bit of a breakout here in Bitcoin as the inflation numbers come down. And what's happening is you're seeing money go back into the perceived risky assets. And that's why you're seeing that go into Bitcoin here. But I got to tell you, folks, overall, stocks are liking this. Even gold is up. GLD, let's take a look at a couple of charts here real quick. GLD is the gold ETF up 2.3%. Closes here. It's the best close we've had since July, actually end of June. And this is obviously being helped with the U.S. dollar falling. Here's a U.S. dollar index ETF, UUP, well below the 200-day moving average now, down 1.2%, down to the lowest level we've seen since August. So we're seeing the U.S. dollar come down. This will be very good for U.S. multinationals because the people outside the U.S. buy their goods in U.S. dollars, in their own currency. And as the dollar goes up, they can buy less. So this is actually really good going forward. So again, we're seeing Bitcoin spike. We're seeing the market spike. We're seeing gold spike, U.S. dollar come down, the yield on a 10-year coming down. And let's take a look here at the QQQs. This is NASDAQ 100, up about 3.8% right now, right up against this line. It's tough to see that downtrend line, right up against that 200-day moving average. And then the S&P 500, the SPY index, well above the downtrend line, well above the 200-day moving average. And it closes here to be the best close since the spike in early September. So again, folks, we are seeing the market react and how they like it. Before we wrap the show, we're now about 36 minutes in. We're at the low today, but we're still up 2.1% in the S&P 500. The NASDAQ 100 also in the low today, but still up 2.9%. We will see how we trade throughout the day. It could be a wild trading day. The yield in a 10-year is 3.45, so well off the 4.3 that it was at just back in October. And I think the yields continue to drop down, and that's sending bond prices higher as well. Gold's up as well. Bitcoin's up. Having a fun day. Hopefully we end up closing on a bullish note, and we can head into the rest of the week feeling good. But again, thank you so much for watching. Thank you so much for supporting. I hope this show really helped you kind of break down these CPI numbers and realize that inflation is rolling over, regardless of what any talking head out there is saying. Have a wonderful Tuesday. We'll be back Thursday with a great interview with Scott Garlis, the editor of Stansberry Newswire. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.